Good morning and welcome to AZZ Sell-Side Analyst Day. I'm David Nark, the company's Chief Marketing, Communications, and Investor Relations Officer. Today we are webcasting our morning session live from approximately 8 a.m. to 9 a.m. Central Time today, and our remarks will include an overview of the company and important elements of our long-term strategic plans. Our presenters today are Tom Ferguson, the company's President and Chief Executive Officer, Jason Crawford, Chief Financial Officer, Kurt Russell, Chief Strategy Officer, Jeff Belines, President and Chief Operating Officer of AZZ Precoat Metals, and Todd Bella, Senior Vice President of Metal Coatings. After our management presentations, we will take questions from the in-person group. Please note that the webcast and its replay can be found at www.azz.com/investor-events. Before I begin, I want to remind everyone that management's comments today will include forward-looking statements made under the safe harbor provisions of the Private Securities Litigation Reform Act of 1995. By their nature, forward-looking statements are uncertain and outside the company's control. Except for actual results, AZZ's comments containing forward-looking statements may involve risks and uncertainties, some of which are detailed from time to time in documents filed by AZZ and the Securities Exchange Commission, including the latest annual report on Form 10-K. These statements are not guarantees of future performance, therefore undue reliance should not be placed upon them. Actual results could differ materially from these expectations. In addition, today's remarks may include a discussion of non-GAAP financial measures, which should be considered supplemental to and not a substitute for GAAP financial measures. We refer our shareholders to reconciliations from GAAP to non-GAAP measures contained in today's slides. With that, I would now like to turn the discussion over to Tom Ferguson.
All right, thanks, David. And welcome. As we'll talk about, we believe we've got two outstanding operating platforms. We try to keep most things as simple as we can and focus on providing outstanding quality and service to our customers so that we can provide superior value to our shareholders. And we'll talk a lot about this on page 4. We are the largest independent and metal coatings provider for hot-dip galvanizing and coil coating. And for us, that's important because we're quite agnostic about whose metal we coat. So it doesn't matter to us whose steel or aluminum or stainless that happens to be. We're willing to paint it, hot-dip, galvanize it, protect it, make it look better. We have scale in both segments. We'll talk a lot about, or you'll hear us talk a lot about process playbooks, operating playbooks, leadership, discipline, and a deep bench of servant leaders. And so that's important to us. We've continued to invest in those areas because we believe that having great leadership teams out there. As for some of you at dinner last night, we talked about we've got folks that have been with us 40 years and continue to show up and contribute and allow us to grow. And then we got people that have been with us just a few months and are focusing on new technologies and AI. And so, it's just a great, as you'll see today at the Washington site, just facilities are important, but people are critical. Foundation for growing sales and margins. I'll talk a little bit more about that in just a second. We've been very focused on capital allocation, maintaining discipline as we execute. It was fairly easy to pay down debt, get our leverage down before we got back into the market for acquisitions. But during that time, we have been using our significant cash flows to invest in CapEx that have helped us modernize facilities, modernize lines, modernize technology. We'll talk a little bit about some of the technology we're investing in and some of the technology partnerships that we have. So, while we've been successful in paying down debt, we've benefited from, we had divested 60% of Infrastructure Solutions, which helped us immediately bring our leverage down back in 2022. And then receive a significant amount of cash from that, and there's still a couple of assets left in Avail to be divested. So that story's not quite over yet. I think but probably over the next 12 to 15 months that'll play itself out. So hopefully we can anticipate some additional cash coming in from our 40% share of Avail. We are committed to EPS growth. I've got a graph in here that I'll talk to in a minute. And then we do try to keep things pretty simple. We are coil coating and we're hot dip galvanizing. We provide a lot of services around that, but for the most part, those are the two key things we do. And you wouldn't expect it, but because hot dip galvanized metal can last, those structures can last 50 to 100 years, you just think about you're not continually repairing, repainting, and so environmentally friendly. Coil coating is just, we capture over 99% of all emissions versus, as you can imagine, when you're painting outside. So environmentally friendly, cost effective, and absolutely necessary to infrastructure and the construction industries. Page 5. Yeah, as I just mentioned, we're the largest independent post-fabrication hot dip galvanizing and coil coating solutions company. We've got about 4,000 employees on any given day. We do use contractors and temps for flex labor and things like that. Both segments have significant scale. We're fairly balanced between the two when you look at it. And even on the margin profile, when you look at the two businesses on a return after materials percent, they're actually relatively similar in the 35 to 40% range. So while one is roughly 31, 32% EBITDA margin, and the other is roughly 20, they're very similar in terms of the amount of cash and the returns that we have on each one. Page 6, this is what gets exciting for me. We showed when 571 million, we're pushing towards $2 billion. I think we have a clear line of sight. We're finishing up our strategic plan next week, which we'll present to the board in early October. And it's pretty much a continuation of what we've been doing with more emphasis on acquisitions and investing in significant organic growth opportunities. So that's what's going to get accelerated as we talk about ascending. So, we are committed to driving this business to north of $2 billion and 25% EBITDA margins. And while, I'll talk about this in a second, but, and we think just continuing to do what we do, very disciplined capital allocation strategy, focus on high ROIC opportunities, continuing to provide outstanding service to our customers, develop that leadership bench, maintain and develop solid, disciplined playbooks so that we can sustain our processes, because we're tolling, both are tolling businesses, and so we don't own that metal, but it means that we have to be able to differentiate ourselves by having outstanding process discipline and continually making those processes more efficient and more productive. Talked about pursuing bolt-on acquisitions. We got one small one done in Canton. Which is fun, because you would look at, and I think Todd's going to show it, you look at the map and you would not have anticipated that it would make sense to buy a galvanizing plant in Canton, Ohio, when we have a plant less than 5 miles up the road. But it was focused on different parts of the market and a different piece of it, that with our large structural kettle, that they could go after opportunities. And so, as we're becoming very focused and trying to be very disciplined about how we approach these opportunities, we're finding that a lot of things that didn't look all that attractive a couple of years ago can look attractive to us now, and we're very good at running our playbook and integrating on the galvanizing side. We hope to get a pre-coat acquisition done in somewhere in the not too distant future. Page 7, and you've heard me say this before. It's we make our commitments, we execute against those commitments, and we want to be known for doing what we say we're going to do and achieving those things ahead of schedule and as we've committed, if not sooner. So, got our leverage down. We're now in the fun situation of let's figure out how to deploy that cash to provide profitable growth. We both businesses, strong cash flow generation, solid margins. We continue to believe there is some margin upside as we get through the tariff uncertainty, and I'll talk about that in a second. Acquisition policy, whatever we buy, it's going to bolt on to one of these two operating platforms. in the two existing segments. So we're not going to get too exotic out there. Don't look for us to be building a third leg anytime soon. And we've had all the transformation I want to go through. So, I think, but we have a good pipeline of opportunities. We, for the first time in a while, and we increased our dividend, and we're not a high dividend paying stock, but that is something we're committed to now review it every year, and hopefully continuing to increase as we generate these cash flows. We are buying back shares mostly to minimize dilution, so we have a 10b5-1 in place. It has not triggered, but we can also be opportunistic as we buy in shares. That's mostly just to offset the dilution that comes off of the shares we issue for compensation. And with that, I'm going to turn it over to David to talk about because our markets, we do have tailwinds, and as I was about to say around the tariffs, those have provided probably more headwinds than tailwinds, and it's mostly around the uncertainty. It's created some opportunities, and we've taken advantage of that to some extent on the galvanizing side for infrastructure type things. On the precut side, it's been more of a mixed bag. It's fewer metal imports. So it's a mixed bag. But I think what we see projects delayed mostly because of the uncertainty of what they're going to be. And obviously, we've talked about this before. Any kind of a rate cut, we think would start to trigger some of these projects to get kicked loose. But infrastructure stuff is moving forward. Other things that have more discretion, I think our view is they're just being delayed. They're not being canceled or mothballed forever. So with that, David?
All right, thanks, Tom. Yeah, so one of the things that I love to talk about are our end markets and some of the drivers. So as you look at slide number 8 and starting off on the left-hand side, one of the questions that we always get is, what has made this business so stable? We have some slides later on. We go through the financials that you can see the stability of the business on a consolidated basis over time. And it really is a reflection of how diverse our end markets are. And although construction is 55% of our reported book end markets, when you break that down, there's really 3 components within there. There's infrastructure construction, the non-residential construction, and residential construction. And those are about a third each of that respective 55%. So kind of going around from there, you can see the rest of those. Industrial, we touch on transportation. We have consumer related items that we're coating steel and aluminum for, like HVAC, appliance, and of course container, which you'll see that plant later today. Electrical infrastructure, a lot of T&D poles, and then other things, the smaller nuts, bolts, and other accessories that we either galvanize or paint. But collectively, that broad base gives us a very stable earnings flow. When you look at the secular drivers that Tom had mentioned, certainly infrastructure investment has been helping us. I won't get too much into that because I have a slide on the next page, and we'll talk a little bit more about that. Reshoring is taking place. We think that it's going to still take some time for people to reshore, just because they've got to build plants. You've got to certainly go out and acquire the equipment that needs to come in and be commissioned for that. But there's no doubt about it that that's a trend that's occurring and will benefit us over time, since we're North American focused. There's certainly a migration, and we've all talked about the migration from pre-painted steel to aluminum that's happening in the manufacturing space, and also conversion that's happening both on plastics to aluminum, and the conversion from using wet spray, as Tom mentioned, and things that are not as environmentally friendly to coil coating, which is a much more environmentally friendly process, which you'll see demonstrated later today. Talking about AIIJA and the impact going forward, as you kind of look at this, we're 3 years into a 5-year legislation. Collectively, there's been $454 billion that has been allocated to over 60,000 projects across 50 states. How that really affects us is there's about $110 billion in roads, bridges, and major projects that's been announced and awarded, $65 billion in clean energy and power, and then $75 billion allocated toward data centers, water, airports, and other types of infrastructure projects. So We are well aligned to take advantage of that as those things move through the pipeline, and they are moving through, some of them a little faster than others. As Tom mentioned, infrastructure seems to be doing really well. We do a lot of galvanization on the infrastructure side. So we're encouraged by that. We think, again, when we talk about tailwinds in the business, this will be a tailwind for us for some time. Moving forward to slide 10, strategic value proposition. Oftentimes we are asked about, what makes these businesses logically put together, going forward, and why metal coatings and pre-coat metals. I think as you look at it, we do have a #1 position in the marketplace with both of the segments that we operate today. Both of the businesses fundamentally are tolling-based businesses, which means we have minimal, if any, commodity risk. Again, we don't buy paint we do buy paint. We don't buy aluminum or steel. Our customers do that, and we are just merely caretakers of it as we paint it or we galvanize it. So fundamentally, tolling-based businesses is what we are at our core. We have a lot of technology that's proprietary. I'll talk about that going forward here in a few minutes. And then, as Tom mentioned, we really focus on a servant leadership culture and a service-minded culture focused on our customers and on profit. Just a brief touch on technology. As I mentioned, we have some proprietary technology that we believe gives us an advantage in the marketplace, starting with our digital galvanizing system. You've heard us talk about that in the past on several calls, but this has eliminated nearly all the paper in our operations. It's integrated into our back-end systems, and it's providing us with real-time decision-making process from the frontline individuals who are scanning and taking pictures of steel as it's approaching our yard to the time that steel is leaving the yard and providing customer notifications. Similarly, on Coil Zone, that's the industry-leading tool that is in the pre-coat metals business that allows those customers to log in. We also have a lot of EDI connectivity with those customers, so our systems are seamlessly integrated with their systems, which makes us very sticky. And then finally, as we kind of talk broadly, across all businesses about IT infrastructure and AI, we have been investing in systems architecture and getting ourselves future ready for AI. We do have policies and procedures that have already been established and communicated to our organization around appropriate use of AI, and we've already begun to deploy it in areas like Microsoft Copilot and Teams. So it's helping us make better decisions. Really quickly on R&D, we're really proud about our partnership that we've had with Texas A&M since 2019. That partnership has allowed us on the hot-dip galvanizing side to really advance the ball forward in a lot of different ways. And some of those include operational activities and safety procedures on the product quality side, and also fixturing, which we use in the galvanizing process. And then the other things that we're really excited about has been the ability to reduce costs and improve quality through reduced usage, better use of things like acids and other consumables that we use in the process, and it's certainly helped us with reduced emissions as well. One quick note on sustainability. I think what I'll do is just hit the highlights on the top 3 here. We have been and are a very essential and environmentally friendly operation. We are very mindful with that and the way we conduct our business. We have been leading the industry with respect to our initiatives and reporting. We have had 3 years and now working on the 4th year of communicating our ESG efforts through our ESG reports, which you can find on our website under the sustainability section. That includes Scope 1 and Scope 2 reporting and feedback on that. We have targeted a 10% reduction, and we're on track to exceed that before our goals. And then, of course, with sustainability, a key aspect is people, and we recognize that our people are the key to driving a sustainable business, and we are actually a very diverse organization as well. So with that, I'm going to tip it back to Tom, and he can talk about the team a little bit.
Yeah, it's great when you've got a good, experienced team, and it makes life a lot easier for me. But Jason had been the EVP of Finance here at Precoat, so a little over a year ago, we brought him in as CFO in Fort Worth, and You can tell he's developed that Texas accent. You can find it real quickly. And his business focus, finance support. Just it's as we move to get more aggressive in profitable growth, it was a good move. Brian Stovall, Todd's representing him. He had a little minor surgery earlier this week, but about 35 years with us, so tremendous experience. Jeff took over for Kurt, and we were fortunate. Kurt's been driving strategic opportunities, which we won't talk too much about that, but I can tell you it's a key part of why we're more excited about the shorter term opportunities for growth. Because he's come up with some really good opportunities that we're looking forward to pursuing over the next 12 months or so. Tara, Chief Legal Officer, she also manages our ESG, been with me since almost the beginning. David was here just before I got here, and we just keep adding responsibilities to his title. Chris, he's our corporate development guy. He's done a lot of deals while he's been here, and Haley runs HR, and Roy, just an outstanding experienced guy on the IT front. And so we anticipate doing some really good things with, I won't claim to understand AI all that much. I'm going to go off to a conference to learn more. But I think it brings, because we've got so much data through our systems and processes and things like DPS and COSA, that that's what gives us the opportunity and can get us excited about how we utilize AI going forward. So, good team, solid leadership, and we work well as a team and get along great. So when I talk about family, this is kind of the first family of AZZ, and just sets the tone for our whole organization. With that, I'll turn it over to Kurt.
Okay. Well, thanks, Tom, and thanks again to everyone for joining us, making the trip to St. Louis, hear the AZZ story, and hopefully be excited about the plant, which you can see here in just a little bit. We've got a few of us between you and that, so we'll try to hurry through it. On slide 16, I'll expand a little bit on the strategic journey that Tom mentioned, give a little bit more color to that. Rightfully so, our focus over the past several years has been debt reduction. Clearly that's been the priority, and we've been strategically aligned around that. But we've continued to grow organically through that period, and you'll see it come through in Todd and Jeff's presentation, the organic growth that we've seen while we're focusing on the debt reduction. So we've definitely demonstrated the ability to grow organically, and that continues to be a focus of ours. David highlighted the markets. We really like the markets we're in. We like the diversity as well as the performance of the market and the outlook of the markets going forward. But that's not the only driver for the organic growth. Both businesses have a business development function that is integrated inside the business and a pipeline of organic projects. So the ability to grow greater than GDP organically, we feel comfortable with that. Jason will talk about the capital allocation strategy in just a moment, but we can plan to continue to invest and accelerate the high value, high ROIC projects for the organic growth. Tom has mentioned, I guess probably the last 3 or 4 investor calls, that we're moving more to shifting focus to M&A, and clearly the Avail divestiture of the electrical business was, that was a big catalyst for accelerating that. And over this time period, we really started out by honing our investment thesis. What do we want to be in terms of M&A strategy? And we've got that aligned, and I'll talk about it in just a moment. But as well as developing the investment thesis, the guardrails, evaluating the opportunities, we've been reviving the pipeline of opportunities that are in front of us. Both segments had a pipeline. We know where the opportunities are, what we'd like to do, but we've revived that as well. So if you flip to slide 17, this is a little bit about our investment thesis. Like I said, we like the markets, so we're going to continue to focus on opportunities that are aligned with the current markets or complementary to, aligned with the current processes or complementary to, i.e. we're not looking for a third segment, right? We feel comfortable that there is opportunity in the existing segments. We do like geographic expansion inside of North America. That doesn't say that we'll never look outside, but we feel comfortable that there's opportunities there. So this kind of sets the funnel or the filter, if you will, for evaluating the pipelines. we've identified over 68 opportunities that we like. So a robust feed into the filter or pipeline. When you apply those filters to that, and a view of actionability, right? With M&A, that's a key point. You have to have the capital. Again, Jason will talk about that, and you have to have the opportunity, and it has to be actionable. So we've kind of filtered it to a point that we have 13 opportunities under evaluation at various stages, and as Tom alluded to, we just acquired and closed on Canton Galvanize. So what I will say about these opportunities is they vary in scale. Like I said, they're different phases of the process, from NDA to due diligence type activity. But they also vary in scale from Canton Galvanizing single site to something much larger than that. So there's a lot of energy and excitement around that, and I'll kind of finish that with we're very mindful of our target leverage range. We haven't lost sight of that, and if you look at the most aggressive scenario inside of this M&A strategy, we're going to be comfortably inside of that leverage range. So we feel like we're in a pretty privileged position. We have the opportunity, we have the ability, we have the capital, and we have a strategy now that we're going to focus on M&A to supplement the proven track record on organic growth. So with that, we can talk about the exciting stuff, and Jeff and Todd can get into the segment. So I'll turn it over to Todd Bella, and he can tell you a little more about metal coatings.
All right, thank you, Kurt. The picture on slide 19, I think, is a really good snapshot of what many of our sites look like. You'll see a wide variety of fabricated products arriving from our customers that we galvanize. We have the #1 market share in North America with a strong reputation for quality and service, and we're proud of the success, growth, and expanded margins over the past 5 years. Talking about our value proposition, our goal is to be a one-stop shop for our customer needs, and that could involve a big project with very large pieces, or we receive a high quantity of small parts, or even transportation to the job site or to the customer. We're aided by continuous enhancements to DGS that help with customer communication and operational efficiency. And we definitely lean into our large footprint and size to provide unmatched service and quality. Slide 21 shows that footprint a little bit, and you'll see how we're well positioned in the US and Canada. Our large customer base and diversified end markets are a big strength. We continue to look to grow with both our current customer base and pursue new end markets. Taking a look at our financials and the positive trend, the large majority of that growth has been organic. Our stated EBITDA margins were 25 to 30%. We've since raised that to 27 to 32%. Then on to slide 23. As David said, we have the wind at our backs currently and moving forward with reshoring infrastructure spending and the data center work. We're going to continue to focus on organic growth through sales activities and operational excellence. Pounding the pavement on M&A opportunities, vertical integrations, and partnerships. And our general preference has been to buy into a market with synergies or brownfield expansion, but we've had success with greenfield, so we'll keep our options open if any opportunities arise. Go ahead and turn it over to Jeff.
Morning, everybody. Welcome to St. Louis. And like I said, really looking forward to the group getting a chance to head out to the Washington facility later this morning. So if you don't mind, turning to slide 25 for me. That'd be terrific. And just in terms of, as Tom mentioned, we're a toll processor where all of our operations are a continuous processing line. And while we do primarily coat steel and aluminum, pretty much if it's a flat rolled substrate, we have the ability to coat it. And so there's not a market that can be coil coated that Precoat doesn't participate in. And so the great news is, just as David touched on with the markets, we love the markets that we're in, and we love the customers that are in those markets even more. And so that provides a lot of opportunity. And you see a kind of a picture down below, for example, of our finished goods warehouse in West Virginia. So switching over to slide 26, some very common themes that kind of goes to Tom's point in terms of the culture, value proposition, and overlap between the businesses that Todd just talked about. But we've got a tremendous value proposition in terms of what we have to offer to our customers. As Todd mentioned, similarly, we have a one-stop shop where at the end of the day, what we do is we paint and provide great coil-coated services, but more than a third of our customers utilize an additional processing service that we offer to add value and provide a better supply chain and more flexibility. In addition to that, we embrace complexity. We know that our customers want to delight their customer, and so our ability to be fast and flexible and nimble, that is what is continually on our mind every day. So we're building our supply chains around our customers. So when you think about the things that David talked about with 24/7, highly customized access to technology, or you think about our operational flexibility, where we allow our customers to be agnostic, as Tom mentioned, set substrate in from anywhere that they need to, and then late point identify, which basically means they're able to utilize our warehousing capability and our ability to toggle between very flexible runs quickly and give them the finished goods exactly when they need them, as close as they need them for their customers, which again is a very, very important value that requires a little bit of planning and work and understanding of our customer's business to be able to do that. And again, as it mentioned, and I'll kind of toggle over to slide 27, but if we had the opportunity to build our footprint again, and kind of as you see the way that the map is laid out, it's a purpose-built footprint that if we had a chance to start over, we built it in exactly the same place. The vast majority of consumption in the addressable market is kind of in this space. Now, to that point, it doesn't mean we're not looking at other places in the map that may not be shown right now and things like that. But again, this is where the demand and the opportunities are, and we're in the flight path of the inbound substrate, outbound freight lanes, which can be truck, rail, boat, and a lot of other areas. And again, as David already touched on, tremendous exposure in terms of the markets that we're in, and I suspect as we talk in the future, the container share will continue to rise as we participate more in that market as Washington ramps up in that space. Again, turning over to the financials briefly, Jason will touch on those a little bit more, but again, as Tom mentioned, we're looking to continue to deliver value for our customers, and as we do that, we continue to expect that this chart will move in a direction we're pleased with in terms of our performance and doing a nice job for our customers. All right, I'm definitely not going to talk a lot about this, but I will just say that I'm going to talk a little bit about the people instead. And I would just say that for a 2-year construction project to be completed on time and on budget, and then with the added little caveat there of achieving a profitability ahead of schedule, I couldn't be more proud of the team, and just looking forward very much to continuing to ramp up with our valued customer partner and providing great value in this market in the time ahead. So looking forward to showing it to you, and I think that'll speak for itself. There's only 4 bullets on this final slide, but I would say they are fairly compelling bullets, and in terms of what gets me particularly excited about with the team and about the business. As David talked about, we've got some really nice tailwinds. No example is smaller in terms of the shift from plastic to aluminum, which justified the investment that you're going to see later this morning. Again, when I think about what we're really competing with, it's really alternate materials. And we have a team that's really focused on finding out how does coil coating stack up versus alternate curing technologies and other options. And there's so many opportunities in that area for us to grow in North America. It's a very, very exciting pipeline of activities to continue to evangelize the benefits of pre-paint coil coating and pre-coat. Well, we can skip Jason if we want. So, and then, last but not least, I would just say that as Kurt talked about, there's an exciting pipeline of opportunities, and also I think we've got a solid track record that you're going to see later this morning in terms of continuing to consider greenfield plant expansions if they exist. So with that, I'll turn it over to my friend Jason Crawford.
Perfect. Thanks, Jeff. Sweet one. I guess turning to slide 32, I think the key element of this slide is the very first comment in terms of consistency. I think you go back to a comment that Tom made earlier on. We set our goals, we set our objectives, and we deliver against them. I think you've seen from both businesses the consistency that we've demonstrated coming through our transformation phase. If you look at our CAGR from a sales point of view and then leveraging that from an overall earnings point of view up to a 10% CAGR, and then just take a quick look at the margins. The margins are something that we've continued to invest in, albeit that, as you think of our transformation phase, we've been solely focused on paying down debt, so it's an area that certainly provides an opportunity for us going forward. Moving across to the next slide. As you look at another key element that's not really been demonstrated in the most recent past, you need to go back to calendar year 2029, 2010 in terms of our resiliency. if you look at our overall business model, there's a lot of components that make up who we are as a company, but if you start to think about some of those elements, the tolling model, the highly variable cost structure, when there is an element of going through a phase in the markets, we weather that storm very well. And then as you look at coming out of that storm, we position ourselves as a company to take opportunity of the available market space. This is a cycle that we generally go through on an annualised basis. Given our concentration in the construction market, coming through a summer phase to a winter phase, we're consistently ramping up or ramping it down to accommodate the markets that we participate in. So when we do face a potential cycle, then we're uniquely positioned to manage through that. Moving across to slide 34, obviously this has been the key focus for us over the last number of years. As you look at that transformation phase, obviously a lot of key elements that go behind the success, and our leverage taking us down to 1.7 in our most recent financials. Consistently generating free cash flow and allocating that key free cash flow to paying down debt. But equally, as you look at the joint venture, very upfront we sold 60% of the Avail joint venture, and then most recently we transacted that and received around $273 million worth of cash. So that's got us in a position where we're very, very comfortable in terms of where we sit from an overall capital structure point of view. If you move across to the next slide, you start to look at where we've been to where we're going. I don't think our value proposition changes as you look at the superior returns that we provided back to our shareholders. We're going to consistently provide that. Really where we start to do is we start to spend a little bit more time and effort in the return of capital investment projects and strategic M&A. As you look at the last number of years, most notably the last 2 years, between the roughly $60 million that we've been spending in the new facility and north of $100 million of paying down debt, that's no longer a sucking aspect of our capital structure. So we then start to look at where do we deploy that. Again, I go back to our gross margins and the profile. There's a number of projects that we've continued to invest in, support the businesses, etc. But there's a number of projects that have sat there on the sideline at the same time. So we get the opportunity to really lower the bar to invest back in the business and the health and the strength of the business. And as Kurt highlighted, there's a pipeline of M&A opportunities that if you take our capital structure into account and our free cash flow generation, there's a tremendous opportunity to bring those two together. Move across to the next slide. We don't, we talk about being a unique coatings company. We don't really fit well with many of our peer groups. Certainly we participate in each one of these segments, but as you look at AZZ as a company, we don't necessarily sit in any specific segment. When you start to look at our financial returns, whether it be revenue growth or EBITDA margin or net working capital, no matter who you're comparing us against, then we sit at the higher tier of that. And again, a lot of the structure here that we've developed over the last couple of years is a foundation of where we go going forward. And it's really about building on this and continuing to grow our sales and our margins. And then finally, just reiterating our guidance, obviously in the last financial report in Q1, we upped our guidance. You can see our sales number between 1.6 and 1.7 billion, adjusted EBITDA between the 360 and the $400 million, and then our adjusted EPS between $5.75 and $6.25. So with that, I'll pass it across back to David.
Okay, that concludes our prepared remarks and presentation. What we can do now is open it up to any questions we have from anyone in the room. Since we are live webcasting this, if you would just state your name and the company you're with before you ask your question so we can pick that up.
I'm Mark Reichman with Noble Capital Markets. You've been successful with the bolt-on acquisitions within the metal coatings business. And I was just curious, when you talked about the 68 opportunities that you've identified and 13 under consideration, what's the, you kind of know what the profile of the bolt-on acquisitions within the metal coatings division, but could you talk a little bit about the opportunities in pre-coat metals?
Yeah, I'm happy to address that. So when you look at we've tried to take a balanced approach in filtering down to metal coating and pre-coat metals. And I would say that the landscape doesn't look dramatically different on the pre-coat side than the metal coating side. There are some small, single site type bolt-ons. But additionally, there's multi-site opportunities out there as well. So I guess I would answer it simply that it's very similar in terms of the population. You don't have to do much math to kind of see that the ratio of a coil coating line to a galvanizing line is about 3 to 1 in terms of the investment to build, the amount of revenue it can generate, similar financial profiles, and there's 3 times more galvanizing sites than coil coating. So there's that aspect of it, but there's kind of a mixed bag of all of that.
Yeah, good morning. My name is Ashraf Punjabi at Baird. Tom, you had started off the conversation with the similarities between the two segments, right? The EBITDA margins are quite a bit different, so almost 10 percentage points roughly between the two. What do you think would drive? Do you think it's reasonable to expect a convergence in terms of the margin profile between the two segments as you embark on your acquisition activity, et cetera?
I think there's upside opportunity on the pre-coat side. We'll continue to invest and modernize. And like this investment in Washington, that's going to be a higher margin business, partly because of the customer base and the value-added services that it provides. So I think that hopefully there may not be that much convergence. I think there's still some upside. We have not pushed the range up on metal coatings yet, but I think as we're now looking at some of the focus on what else we can do, how much we can use the amazing amount of data that we have to leverage that business. I would anticipate as we think strategically that there's opportunities to push metal coatings up just a little bit. And then as I mentioned, the biggest issue, and it's not that most of the paint, which is over half of our cost on the pre-coat side, is more of a pass-through. We do have some margin on it, but it's typically specified by the customer, so we're accommodating their requests, which means we don't have nearly the margin on paint pass-through as we do, and versus zinc, which is a commodity, 20 to 25% of our costs. So while I see improvement opportunity pushing towards the upper end of the current range, and then hopefully being able to expand beyond that as we get some of these deals done and just continue to build scale without increasing our overhead structure. So we want to continue to leverage both the overhead within both segments, but also leveraging that corporate overhead structure that maintaining that efficiency. So it's a long answer to a straightforward question. Thank you.
Adam Tallheimer at Thompson Davis. I was curious if you could comment on the 2 times GDP growth potential, organic. Was that for both segments? And maybe you can just give some color on what drives them.
Yeah, I see it for both segments. I think on the metal coatings side, it's going to be a continuation of just maintaining market share. There's continued growth in infrastructure, so we see those tailwinds. We want to be able to grow beyond that because we've got the size, the scale, the network, and we're continuing to add services. So everything from transportation and freight, just get bigger wallet share. So that's how I see metal coatings getting to above 2 times GDP. On the pre-coat side, I think we've got the ramp up of the new facility. We've got the ability to invest CapEx to continue to modernize and expand, and also expand services and opportunities. And as Jeff alluded to, there's some technology things that we can do that we think will give us some advantages, and then maintain that flexibility as an independent supplier. So it really is on both sides. And then obviously I think there's acquisition opportunities on both sides, but they're going to move the needle more on the pre-coat side. Yes.
Nick Giles with B. Riley Securities. You've had such success with the bolt-on strategy. Can you just kind of walk us through what that looks like from day one after you make that acquisition? Kind of what are you doing on day one versus day 60, day 90? What is that process?
Yeah, and that's where it's gonna. I'd say on the metal coating side, typically Yeah, because we are significantly, for the most part, we're significantly higher margin than most of the companies we're buying. And that comes down to the playbook and leadership. I won't regurgitate that too much, but so we went to, as quickly as possible, brand them AZZ, get them on Oracle so that we can utilize DGS. And so usually, and typically, particularly on a one-off, you're talking about 5 people in the front office. And so we're sending in a team that's done this time after time after time. And by the end of the first week, if not at most the second week, they're on DGS, they're operating to our playbooks. And we're providing the management oversight, whether it's at the regional level, sometimes we insert one of our plant managers. So it's a very quick integration process. I mean, Todd can comment, but you know, we've owned Canton for a little over a month. I'd say they're fully integrated and functioning and following our playbooks.
Yeah, no, I would just add that I think with our history of bolt-on acquisitions, I think we've learned and developed kind of a rinse and repeat approach that we can take from one facility to the next by bringing in a group of top performers to help get the plant rolling and right into the AZZ speak.
On the pre-coat side, because so much of it's going to be more dependent on what's the age of that line, what are the markets that it's in. I'm gonna say, while we'll be pursuing synergies, a lot of that is just expansion of market customers' capacity. So some of these opportunities might not be as synergy rich, if you will, which means we're also not we may not be able to come in and say, this is how we're gonna run it because of the technology. So it's just a wider range of approaches that we're going to have to take. I don't know if Jeff wants to.
No, I agree, and I do think we are able to take advantage of our centralized structure, though. So in terms of the way that we're organized, I think that we're able to take the best practices. I think the fact that we participate in every major market, to Tom's point, depending on what the opportunity is, we're going to be able to apply our playbook and our best practices to that. So I think again, it speeds the integration, which we'll customize to the opportunity, as Tom mentioned.
I think the key to look for there is we're going to want to buy it at something less than our multiple, and I mean it's the same on the metal coating side. Typically the multiples there have been they used to be in the 5 and 6 range. I'd say they're probably in the 8 to 9 times range. But obviously either way we're going to get both a multiple bump as well as fine synergies.
Tom, it may be worth mentioning on the pre-coat side, while it's not in the public space, just because of our ownership structure prior to AZZ, there's a long history of M&A and pre-coat. And if you go back to the cycle slide that Jason shared, you kind of notice the EBITDA pre-coat at that point in time was 40 million compared to touching 200 million now. A huge part of that growth was M&A, both multi-site, an acquisition of an equal, and that was integrated in about 6 months totally and synergized. And then the most recent was probably 2017-18, the Columbia site, and it's very similar to what Todd had described. We were operating on the pre-coat centralized system within the first week, so it's not that much different. The difference is, the public track record is not really out there on the pre-coat side.
Dan Rizzo from Jefferies. So the target is 22% consolidated EBITDA margins, but given all your efforts and what you're doing going forward, that seems a little conservative.
Yeah, that's why I kind of threw 25 out there. I think that's as we look forward strategically and move forward, particularly from a business perspective, maintain the corporate entity as it is. I think that's going to lever up, and particularly as we're looking for acquisitions and we can acquire those without any significant increases in either the segment overhead or in the corporate overhead. So I think there's opportunity there.
And in pre-coat side, with the acquisitions you're going to make, these are more like turnaround stories where they're kind of an underutilized asset that you can make better, or is it something that just seamlessly goes into your network, so to speak?
Kurt, you want to take that one?
Yeah, so there's both, to be honest with you. There's and I would add complementary to that, both in marketing capabilities. So, and I'm speaking to obviously the inside I have the ones that we're focused on, but it kind of has all of the above on that. Okay. There's some that are turnaround. And, metal coatings, one beauty of both businesses that we didn't really talk about is the ability to leverage best practices. And, when you think about any business or any plant that has the ability to look inside and get complete transparency to its top 5 competitors and know what they do well, those segments have that ability with the other plants. And that's, we bring that to bear at all of the acquisitions as well. So it's a little bit of all of those. Thanks.
Eric Boys, Evercore. Appreciate the look back on slide 33 of the prior cycle now with Washington and maybe more kind of consumer packaging mix in there. Does that kind of dampen some of the variability on the pre-coat side even more in the cycle?
I would think so. I think there's growing demand for those assets, and which is why it's ramping up nicely. And I think also outstanding work from the team that's brought that online and overcome a lot of challenges. But yeah, I think it does probably protect that mix, if you will. And we've talked about the fact that because so much of our costs, so on the pre-coat side, in a downturn, you quit buying paint, you cut shifts, and so that variable cost can adapt quickly. But I would see modern assets, we can run a lot on these new modern assets, state of the art. So yeah, I think it becomes another protective layer in terms of our ability to protect margins through a down cycle.
John Bronx, Kansas City Capital. On the coating business, I don't think there's a lot of new galvanizing facilities coming on stream. Can conditions, if the secular winds play out the way they are, can the conditions in the galvanizing business get tight and allow for some pricing?
Yes.
Has it in the past?
It has in the past, and I think for us, and we always talk about the fact that we've got 42 sites, and I want to win 2/3 of the battles every day, and so at any given time we're probably averaging 2 shifts. We're in the heavy season, but so the capacity constraints ebb and flow a little bit with the construction season. But yeah, I think we've been known to push price through up and down cycles, and we're seeing zinc as a commodity, the cost of zinc rise. So yeah, I'd anticipate Todd's sales teams are going to be as aggressive as they can, and we talk about it, but we have to earn that with short cycle times, outstanding quality and service, and making sure we're there. And the advantage, of course, we have in capacity constraint situations, which are occurring in some areas right now, is we can flex across our sites. And so, like in North Texas, we've got 4 kettles, 3 sites. I can guarantee you, all 3 sites are not equally busy every single day. So one of our strengths is we can move capacity to the site that accommodate it and meet the customer schedule, and then charge for that.
Am I correct that there are no new galvanizing?
Now there's some. There's a couple. One of our multi-site competitors, and then Nucor has a line going in. Of course, it's going in with their additional capacity, so it's more vertical integration. So yeah, there's been a couple. I'd say if you just look at it, there's always going to be they average about 1 a year. So it's, in the overall scheme of things, it's not huge. Sometimes if it's in our backyard, then yeah, we feel the effect. If it's more of a vertical integration play, we don't feel it. So.
I'll ask one. Jerry Switty, Roth Capital. A little different tact. Talked about tailwinds, but you also mentioned business development. Even on like the galvanizing side, there's a lot of value add in terms of longevity. Is there a way you can actually pull through some business on the business development side, go out and market that benefit and maybe drive additional demand?
There is. We've talked a little bit about this, and So there's some of our customers have at least a portion of their galvanizing is vertically integrated.
Mhm.
And we think we can probably do that better than they can do it. We just have to prove that. So, going into, so from a business development standpoint, approaching customers to take over their vertically integrated galvanizing operations and commit our galvanizing capacity, whether it's nearby or requires some transportation support, we see that as opportunities for us because of the strength of our network and the breadth of it. And there's just not a lot of places out there that we don't cover with capacity. And so the need for somebody, and we see it because when their kettle goes down, particularly these days, to get a new kettle used to take about 6 months, that could take over a year now.
Mhm.
So what used to be something that was relatively routine before we got into the disruption from whether it's tariffs or just capacity for machinery, furnaces, kettles, things like that, that used to be more attractive for businesses, but it's becoming less so. When you're down for 12 months and you have to buy from us, or you have to buy from somebody, and you may find at that time that the capacity is relatively constrained.
Mhm.
And so I think those are opportunities. That's why BizDev is such an important issue for us, and we're putting so much emphasis on it.
How big is that opportunity?
Yeah, I'd say we're still quantifying it, but it's back to if you looked at them as acquisitions, that's also how we see getting to 2 times the GDP growth. We think that's part of the
Okay.
how,
Got
and there's lots of them out there. It's just, and they can be really small kettles, they can be relatively larger at times. But that was just stuff that we used to it's not that we walked by it, but we would pick up on it because, they're having a kettle change. And we're picking up their business for a couple of months. Versus now, okay, when we pick it up, can we go in and convince them that just let us do this work for them?
Yeah.
So I think, and also with the cost of capital for them is in most cases higher than our cost of borrowing now. So we've got different opportunities than we had probably 5 years ago.
I could ask another one, kind of shorter term. Could you maybe talk to the interplay between kind of what was maybe a slowdown in orders after kind of pre-buying ahead of tariffs versus maybe some incremental business you guys are getting from people no longer importing already coated coil?
Yeah, well, I'll let Jeff take that one because he's on the front lines of it right now. So.
Yeah, I mean, I think you kind of quantified the question well, Eric. I do think that with a lot of the uncertainty and some of the tariff actions that have taken place, it does seem like some of the statistics I think that maybe David had shared in the last earnings release kind of supported that there was maybe some buying ahead in advance of some of those changes, and then that's going to drive up. I think inventory levels to your point around orders, and then. I think that customers are, pulling from inventory as a result of that, and then, standing on the sidelines in some cases a little bit, trying to make sure, what is going to happen next. And so they want to be conservative in terms of, potentially, and I think that both Tom and David touched on it, standing on the sidelines right now in some cases for some of those projects to say that let's wait and see, or, maybe have a little bit extra inventory than they would have had previously because of some of those actions. So I think it kind of goes to, some of the customer sentiment, just around uncertainty and wanting to make sure that as they replenish and support their customers that, they see a clear path in terms of, how the supply chain should and need to develop and under what cost structure, given all the changes there are right now that there seems to be a daily update one way or the other.
Mike Kapinski, Noble Capital Markets. You mentioned interest rates as being somewhat of a fuel for the prospect of seeing some acceleration in revenue growth. I was just wondering, what are typical lead times in terms of that? Typically it would be obviously some, if we're anticipating some rate action in September, I was just wondering in terms of how far do you see the lead? Like, are you starting to see a pickup now? It would kind of indicate that you should be, if people are anticipating that.
I think that's, okay, so one of the, We'd love to see the rate reductions, which hopefully would trigger some of these projects to move forward. But I think the issue on trying to figure out the timing is just as I mentioned, the lead times on major equipment. So if you're having to get major machine tools from a US supplier because of the cost of the tariffs, or maybe something that maybe you could import before, you know, we're seeing those lead times for even stuff we buy stretch out to 24 months. That used to be sub 12 months. So, well, we need to see it because we need that signal for people to start placing purchase orders, but it's, you know, it's gonna be at least a few months, if not a few quarters, before that turns into galvanizing opportunities and paint opportunities on the whole side. So, but we'd like to see that as a positive signal to start triggering some of these things. Now, hopefully with reshoring and other things, that'll start to bring some of these lead times back down, but I see that as kind of 18 months out. And some of the reshoring is actually creating some of the new demand on heavy machinery and things like that. So while these are all positive signs, and I was talking at dinner last night, the good news is it'll extend this cycle for several years beyond what it might normally be. The bad news is it's probably 12 months out before we start to see real significant benefit from it. What I do think happens in the short term is things have been held up because nobody wants to commit that $1 billion project and then find out, no, we just had a 50 bip rate reduction. And oh, by the way, what's going on with tariffs? Is it up or down? Can we buy it from Mexico or not? Because, you know, fortunately for us, very little of our supply comes from outside the US. We do get some zinc from outside, but it hasn't been, most of everything we're dealing with hasn't been affected, but a lot of our customers, they have. All right,
Okay.
I think we're on schedule.
Yeah, thank you, everyone. That concludes our Analyst Day presentation and Q&A, and we'll look forward to moving on to the plant tour next.